Welcome, everyone. Hope you had a nice lunch. Tonight, I am very fortunate to be flanked by two handsome gentlemen who are really, I think, great choices for this panel because Clement King, he's currently at Wells Fargo, and Ralph Debbas, who is managing director at First Directive. They represent the two halves of what we need to do the job that we are charged with as risk officers. Clement is the subject matter expert, and Ralph represents the technology partner that we more and more need to collaborate with in order to run an effective risk assessment and risk identification. So without further ado, I'm going to ask each of my colleagues here to give a little background about themselves, and then we will launch into our conversation about risk assessment. Clement, I'll start with you.
Perfect. So thank you for coming to New York. I know some of you guys aren't from the tri-state area. I grew up in Staten Island, so I've lived in New York most of my life. Before coming to Wells Fargo, I spent the last 10 years at HSBC. So I did global roles, whether it was New York, London, Canada, come back to New York. I joined Wells Fargo in April early this year, and outside of Wells Fargo, I'm also on 2 nonprofits. The reason why I say that is, as we talk about this discussion on risk assessment management, I'll emphasize a lot about the importance of people, talent, because at the end of the day, we can have the best technology in the world, but if we don't have the people designed to do it, it won't work.
Yeah, I couldn't agree with you more, Clement. I'm looking forward for that discussion. I'm Ralph Debbas. I'm Lebanese originally, immigrated here about 20 years ago. And I started my career in the hedge fund business and then ended up in consulting. I was in management consulting for a few years, and now very happy to be part of more of a doer in a technology-driven company. The reason why I emphasize on the doer is because we are looking for a lot of a good talent essentially in the industry, and what strikes me the most is how far apart the theory and the practice are usually in the business, in the fields, and we'll talk more about that, how distant we are a little bit from applying certain of these theoretical concepts that we have.
Okay. Clement, as the Chief Control Senior Executive and Head of Business Enablement at Wells, what are your current regulatory priorities?
Yeah, so one thing I'll mention, and I have to give this disclaimer, these are my opinions, not of Wells. That disclaimer you guys all know well. I would say the biggest priority right now is understanding how do we manage the budget for today, for tomorrow. And I'll just give you a classic example. Cyber risk has been a priority for the last few years, and it's not going away. So the question is, how do we have conversations with our senior stakeholders, the CFO, to say, this is an area we need to invest, where actually the business may want to go in different directions. And not because of good or bad, but you only have a limited budget, especially when people are talking about a potential recession around the corner. So the first thing, at least a priority of mine, is how do we manage the financials along with the risk prioritization? The second biggest priority is people and talent. We're in a different marketplace than about 3 to 5 years ago. When I make an offer, I usually get someone that says, hey, can we counter, can we negotiate? Where a few years ago, I'd have said, this is the best offer, no counter, no offer. Where now, we really have to think about not only how do we get those talented individuals into our company, but how do we actually retain them? And that's also an interesting dynamic that I'm exploring right now is it's great to get someone in the company, but how do you actually retain them, make them motivated? As I was joining my career, or in the beginning, there's sometimes I did a bigger role without a salary increase, I had a lateral role, and it was just expected that I would do my time. Where now when I'm speaking to a lot of individuals, they want to get promoted quite quickly. So how do we kind of balance that? And I think this all ties into the question of risk management, because risk management, I think, is a field where you need experienced individuals, you need to be able to think strategic broadly, but you need people to grow within your organization. So something that we've been exploring is how do we get people without a traditional risk management, audit, or compliance background into our company, and then teach them. So kind of grow it in-house. So you guys know the term build a broker program. We're thinking about how do we build our own risk managers? How do we build our own control managers? And then obviously the next biggest piece is how do we do the right storytelling and insights? Data is great. Information's great. But if you guys are anything like me, I'm probably in 10-hour meetings a day. And I get a bunch of emails. Sometimes I'm not sure what's a risk, what's an issue, because it's just data. Where actually we need to think about what's the story, what's the message. And then if we say that same story or message 2 months later, how is that consistent? So many of you guys probably deal with the regulators. One of the challenges at my prior organization we always got was, you told us something 2 or 3 months ago, but it's different now. So how do you join all of the pieces together?
And you mentioned data. I read in the latest national risk assessment that US dollar transactions account for 40% of all global payments. So our little space here in the USA accounts for a great percentage of the world's traffic. And so with that kind of volume, data has to be reliant on technology. Gone are the days of manual sorting. So to that, Ralph, I turn to you for some advice about how to deal with that challenge.
Yeah, thank you, Marianne. I think you're right. I think the data is at the heart of the story of many institutions, essentially. But it's quite interesting to understand the importance and the value of data. I think what we're seeing today is more collaboration, right, between different parties, different groups, different stakeholders. There's more emphasis on the importance of data in your what we call in your architecture, in your business architecture, essentially. And your data stack becomes at the heart, essentially, of your journey. But I think if we forget about, if we don't go too technical, essentially, into the techniques and the how, what are the new tools that are used today to get us to the endpoint, we probably have to think about, okay, there's been a little bit more emphasis, essentially, on understanding the essence of what data is used for and how it's used, right? So I think really this new chapter now is really about really taking the time to put a value to the data, a meaning to the data at the source, and really understand it better from the source. And then all of the evolution of risk management as a whole today, right? Whether we have, as Clement has mentioned, essentially new types of risks that are coming in, right? In the past, we used to talk about market risk and credit risk, and specifically in capital market. And it was a very focus on market risk, credit risk, understanding how we assess them, how we measure them, and then responding to different regulators. Today, it's no longer the only two major risks, right? You have so many other risks that are coming through, so many new risks coming through, like ESG and others. And data becomes even more important in that journey. The understanding of the value of data and the meaning of data becomes even more important. And really what's happening, it's swinging essentially from what we used to call a second line type of risk management to really more to become a real-time risk management, real-time first line, real-time risk management. And to serve that, essentially, I would imagine you're probably going to ask me, Marianne, about the evolution of technology with that. To serve that, there's various different tools, but essentially what we're evolving from is this concept of data lakes to more of a concept of computing real-time data at the source, at inception, so that we can be able to predict better the patterns and predict better all these types of new risks that are coming through at the source initially. And that requires a major change in all of these different financial institutions. I know Wells, for instance, very well is going through the journey of change, and many other institutions as well. And it's considering, again, data as a major element at the heart of this transformation as well.
So the value of having someone who's been doing this for 20 years is I can remember the pre-web app days when risk assessment meant sending out questionnaires to the various people in departments, asking them to anecdotally rate how good is your controls with no demonstrative evidence, with no metrics. And today, that doesn't cut it. Today, everything is evidence-based, empirical data.
Yeah.
If I assess a control as effective, I have to show why, how much testing was done, what kind of testing, what were the results. So we've come a long way on risk assessment, and I think the obvious message is that it's so technology driven and dependent. So from your experience, not just at Wells, but just your overall experience, how do you see risk managers using technology more and more in the way that they identify and predict risk?
Yeah, so there's a couple ways to answer this question. And I'd say the first is, if we think about technology risk, which is a subcomponent of operational risk, maybe 5 years ago, it wasn't something we were talking about as much, where now it's critical. And the good example I like to use is, if the online platform where we log in went down 5 years ago for a half hour, not necessarily a big deal. Now, if people can't access their information online for 10 minutes, it's huge. So a lot of companies are thinking about, what are the sensors to detect when something goes wrong almost immediately to be able to identify that. Something that was launched a few months ago was, if you look at Chase or any of the online platforms, we can now do transfers immediate between each other. That's something that wasn't even there last year. So when you mention payments, this is key, where we have to really be in tune to what are the sensors, what are the data coming. When we also think about how technology has changed the way risk assessments work, to your point of just looking at qualitative evidence, I think this could go wrong. We have to look at a lot larger of a data set than we may have had to before. So there's a couple of areas that's changed, but I'd say the main thing that, at least from my perspective, is the first line has a much greater accountability than ever before. So when we think about the first, second, and third line of defense, I'd say a few years ago, the second line was kind of driving and doing more of the charge, where now the first line is held accountable. And the first line should be held accountable, because we ultimately are making the revenue, we are responsible to customers. The other aspect, what I'm seeing at certain organizations is, when I think about technology, is the CIOs or CISOs, cyber, are being elevated to report either to the COO or a senior level. And that just shows the importance of that connectivity in the past. The other aspect where risk assessments have changed, and I can absolutely speak about this for my prior organization, is people used to think about technology controls as a shared service, something that technology manage. Where now the businesses are being held to really understand what's the technology that they're paying for, what's the technology that they're using. Why? Because if something goes wrong with their customers, they're paying the remediation fine, they're paying the customers restitution. So those are some of the big changes that have happened recently, and I think they're only going to increase going further.
You just reminded me of an anecdote. I had a meeting when I was in consulting with the head of technology of a very large global bank, and he made the blank statement, I didn't know there was anything called compliance IT. What is compliance IT? Because the conversation was about, how does IT support the compliance systems that we need to monitor transactions, filter out sanctioned entities. And in his vocabulary, compliance IT was not something he was aware of. It was all business IT. So we have really evolved to a state where technology people are indispensable to what we do as risk managers. So I wanted to ask you, Ralph, when you interact with the organizations that retain your firm for advice, what levels are you interacting with? Is it the front office? Is it the second line? Where is the connection to the entities that are seeking your advice?
I would say it's actually quite interesting. In the past, we used to probably really mostly interact with second line or mostly with technology, and technology as a separate entity. To your point and to Clement's point as well, so technology is more integrated right now in every single team. And it's been part of the business as a stakeholder on the table, committing to the roadmap and to the vision that every organization has, right? It's indispensable today to think about the roadmap on risk management, modernizing your risk stack or modernizing your data stack. I think it's switching. It's switching a little bit, or without having technology on the table as a solid partner. And it actually goes fundamentally with the spirit of the evolution of the market today. You spoke about the talent pool. I can tell you, Clement, it's been difficult for everyone to really get the right talent. But the reason why is actually quite interesting. The paradigm of work and the way people work has changed completely. The reason why I'm saying that is because you probably, in all your institutions today, all of you guys have witnessed a complete change and shift about how the workforce is working today. You want to recruit someone, the first question is, am I accountable and independent on my project? Can I work alone? Or can I work as a team and be almost independent? So this concept of agility and business agility is actually catching up to the labor market. Why is it important to say that? It's because a lot of the institutions today, what they've decided to do essentially on first line, second line, every single line and every single aspect of the business is to integrate technology, part of these teams, and have what we call mixed pods or mixed teams, this concept of pods, where we have a mix between the business knowledge and the business experts, the person who's going to define, she or he, what the requirements are for risk management essentially, and then technology embedded in that team, and that pod independently work on achieving the goal that they need to achieve. So this agility brings a completely new paradigm to the market. Everyone is being more agile, meaning that more divided in more teams and small pockets of teams working together on a vision. So technology is embedded and becomes part of all the change as well. So it's no longer a discussion of, oh, it's technology's fault, or the business has it right, but technology has it wrong. It's really joining accountability between the two and having one single pod or team owning essentially the problem soup to nuts and putting that as well at the heart of it as well.
Yeah, if I can add a little bit to the thing about talent, as I've been interviewing a lot of people recently, another question they ask is, do we need to be in the office? And it's an interesting concept because depending on your role, depending on your experience, I just came from a 10-year-old organization working globally to brand new. Me being in the office even the first day was critically important because I can get my laptop set up. I can talk to an IT guy. I can have that conversation. Or I can have that water cooler chat. Oh, I wasn't aware of that question, having new team members join. So I do think we're entering an interesting paradigm where I don't think the answer is being back at work 5 days a week, or maybe even 2 or 3 days. But I always think about going to the offices, there needs to be an intention and purpose. So when I'm going in, I'm telling my team, hey, these are the 2 or 3 days I'm going to be in this office this week, so I can help connect. And I think those are some of the aspects that we have to think about with our talent is, how do we engage them more? Because commuting, especially in New York City, an hour and a half, this is UN week. One of my coworkers had 3-hour commute to Staten Island early in this week due to traffic. So we really have to be a lot more intentional about how do we engage our staff, how do we train, how do we educate. A training for 4 hours on Zoom probably doesn't work for me. It might work for you. So we have to really think about how do we engage our team a lot more.
And with that, actually, with this paradigm as well, it brings new types of risks as well, that we were not aware of a few years back, right? So again, going back to this notion of, my view is very focused on capital market, by the way, but going back to this notion of understanding risk and different types of risk, there's a new risk that was introduced in the last 2 years because of COVID, right? The risk that, operational risk, IT risk, more vendor risk, essentially. And all of these types of risk need to be added, essentially, in this framework. Technology is a way of doing that, but it has to be integrated in all of these global view of what your risk is and your assessment of the risk globally.
Clement, how closely do you work with technology people in your daily work? Are they a resource, or do you engage them to help you develop better risk models for risk identification?
So I'd say my current role, it's just a little bit different. I don't engage with technology as much. I would say in my prior role, I was speaking to the CIO every single day, maybe 2 or 3 times. And that was speaking to the CIO for a couple of reasons. Number one, what do we need to do to tactically solve a problem? But more importantly, what do we need to do strategically? I always found having a technology partner at the table when we're making the decision, and the design is always better. So my old CIO used to say, don't come to me with the design already fully fleshed out. Let's do that journey together. I'm a business guy. I don't know how to design the ultimate solution, But if I tell her the problem, she can help me get it together, which is quite critically important. But I would say I've engaged technology in almost every role, different ways. My current role, I probably engage them more from a finance perspective, understanding what they're doing, the benefits we're getting. But that's just in a COO role, you're always focused on how do we focus on the financials and execution. But in other roles, we've looked at how do we have the right controls in place, how do we get efficiency, do we have too many controls? And when we think about third parties, from a large global organization, or most organizations now, I think from a cyber, let's use cyber example, I think the banks have really gotten that. Where the risk will always be is the third party, but not the third party, just the fourth and fifth party. And that's where one of the challenges I think a lot of organizations are facing right now is, do we know who all our fourth and fifth parties are?
So I started to ask you earlier about who you engage with. At one time you said it was mostly second line. So do you have any anecdotes of how you engage with the first line in the risk enterprise?
I have actually a very nice anecdote. It was a few years back, we had a big institution, probably represented here in this room. It was a blue logo, one of the biggest financial firms out there. Had a consent order, essentially. And we were trying to understand what do we do about this consent order. And we had the different stakeholders. And the project was about 300-400 people involved in the project. It would potentially be, it has a big impact essentially on the financials of the firm. And then we started the meeting by showing different folks talking different languages, and just a picture. Having different folks, and each one was talking a different language. We have 3, 4 or 5 different languages around the room. And the anecdote was to say, look, this is exactly what's happening on the ground from interviewing you. That's exactly what we're seeing. First line, second line, compliance, audit, every one of you, technology, every one of you is very separate, very secluded, very, very isolated. And you're each one talking a different language, and you're each one accusing the other. It's like, oh, no, it's their fault, it's their fault. So to solve this, we really had to overcome these types of barrier. And again, going back to the point I made a little bit earlier about changing the way we work and functioning in the next 5 years, this is going to be the biggest change probably in the market, right? The way the institutions are, even the foundation of organizations is even built in these big institutions is probably going to change as well, slowly but surely. And it was funny because it's when everyone reflected to that, they all agreed that, you know what, it's true. That's we didn't see the perspective of the other. We didn't really take into consideration essentially all these different factors. And and it was capital for us to push accountability, for us to be able to push accountability for the conclusion of the project essentially.
Yes, I talk about compliance, engaging technology, but it goes the other way around too. With the culture of compliance having been a mantra of regulators now since the 2008 crash at the very least, the front office, first line, even operations has gotten more keen to the fact that compliance should be at the table. So I have an anecdote where we're trying to build a new system in order to process ACH in-house. And that project went on for a while until someone had the light bulb to say, we should ask compliance and bring them into the picture. And that person didn't know why that was necessary, but as soon as we got into the picture, we say, there are a whole host of rules about the timing, the alacrity with which you have to process ACH payments under NACHA rules. And without our input, the system would have been built without all of the controls that would have automated compliance with those rules. So we were grateful that someone had the idea, wait a minute, we can't just build this whole system and leave compliance in the dark. And they actually were right. There was the right instinct, because it would have gone completely sideways if we hadn't given our input into what's necessary.
Yeah, I think now you know this. Now you know.
I think that's super important is from other organizations I've seen, we've launched a system and then we put manual controls or processes in, which is like a little bit crazy, is we have to engage both the second line, even third line, as we're designing things, because then you just have a more efficient process. But I would say part of the challenge, at least in my experience, has been some people don't want to make a decision, and it's too risk or compliance based. And I think the only way around that I found is let's just think about all together. One bank, one customer, how do we achieve it? But I think having second, third line at the table is critical.
Absolutely. I think, Clement, you hit the nail on the head here on one important concept. I mean, I think our industry as a whole, as financial services, we would learn a lot from other industries as well. We're all trying to copy other industries, like, you know, how did Google do it? How did Facebook do it? Maybe Facebook is not a good example today, but, you know, let's take another one that you guys have a lot of admiration for. And we always hear about this being very customer-centric and understanding what the customer wants and drive all of your design based on really the requirements of the customer. And yet in our financial industry, right, I mean, we always don't do that. So I think really the better habits essentially today or the future requires us to really be more efficient in the way we execute these types of projects, and to be much more centric around the customer story and understand what are the requirements, but also get on the journey, well, as you said, in this journey technology to really drive the solution around the requirements rather than the other way around. I think we have this concept that, you know, you and I, Marianne, were actually chatting a little bit earlier, and you told me, look, they have this concept of a data lake. Everybody's trying to do a data lake out there. Everybody has a data lake. And then there's been this joke going around, essentially, that says, okay, your data lake becomes a data swan, actually, unfortunately, very quickly. And it's kind of true because, you know, having a data lake and putting a technology solution without understanding what you want to use it for, or what is in your data lake, or what is the value of the data that you have there, structured or unstructured, it has no meaning. So it's really getting closer to basically to understanding the requirements, understanding the business needs, having this vision that we share together, and working very much in a collaborative manner to achieve this type of product.
Right. And business can't be shy about expressing what it is you need. I learned very early on that IT will not do anything without a business requirements document. And that comes from the first line or compliance. If it's not on the BRD, it doesn't get built or it doesn't exist. And so subject matter experts, people whose job it is to manage risk, has to be able to express what it is we're looking for, what metric would help me. Data is just data. Some data is meaningless. You know, 1 million transactions a day. Okay, gives me some sense of the size, but where are they coming from? Where are they going to? Who are the parties involved? Mm-hmm. What are the reasons that these transactions are happening? So we have to be able to articulate what information we need out of the big data to help us assess and identify risk. It's not up to the technology people. They will build it if we can express it.
Yeah, and look, I think, oh, sorry.
I want to say, and it's interesting when you talk about BRDs, and I think a lot of companies are trying to grapple with how do we operate in an agile technology environment, in an agile environment, especially considering the amount of regulations that our industry has.
Absolutely.
Because if you ask me to say, I just went to Italy a few weeks ago, if you asked me what my travel plans were, it's like, I'm going to go to Rome, eat good food, and that was my customer journey. But obviously, there's a lot more details and planning that go around that. The reason why I just use that silly analogy is, as we think about agile, the customer journey from the business, compliance, and other stakeholders become even more important because you can fail fast, you can learn and adapt, where some organizations aren't using BRDs as much as they did because we want to be able to deliver something for the client much quicker.
Yeah, absolutely. I think that's the evolution. That's why I think that's you guys are absolutely right. It's the evolution. So it's funny because Marianne, you talked about BRD, and then Clement said, look, there's an evolution. We need to be more agile. Then because there's this pressure on business agility, and the business agility, again, as we discussed, are coming from the fact that we have so many new risks out there outside the scope of market risk and credit risk only. So there needs to be more computation done up front, more agility so that the business can understand and manage more proactively and do some kind of predictive analysis as well. But all of that cannot be done if you don't have a little bit more flexibility, more agility into the business, but also in technology. And this notion of pods essentially is a little bit where the market is going now more and more, where they put this mixity of teams. They give them essentially a certain autonomy with a vision and certain rules, what we call standards or rules of the games and the strategy vision, and then they ask them to execute on the project in an agile way. So you might not need a full BRD. You need a high-level BRD, essentially, or whatever it is. And then you really push your teams to execute a little bit independently. But in your team, you have this mixity of maybe a compliance officer with a technology officer, with a technology programmer, with a BA, with a QA, so that you can, and a tester, essentially, to really make sure that you have a defined scope, but an independence in their way of delivering the project and a cohesion between them. And then you deliver these little bits in an agile way, as we said, and then the mix of all these little bits delivers essentially the project. So it's a completely different way of, when I started basically in 2000 my career, it was the waterfall approach, and we had to have all these big teams, 300 people in the room, and then really conceptually come together with a plan in a very waterfall approach of testing all of that and delivering all of that. Today, all of that is basically challenged, and I think this business agility and this desire to go faster is pushing us all to change the structure of our projects and do it more in an agile way.
And I know that the industry has already responded to risk managers' needs because there are so many templates and tools and platforms out there that helps you conduct risk assessment without going back to my old way of collecting questionnaires and putting it all on a spreadsheet, labeling controls. Are they automated? Are they detective or preventative? It was all very manual back in the day. But now there are platforms where you can just plug and play. Give them the right data, and it will give you even a heat map of where your risks are. Red, amber, green, high, medium, low. It's quite sophisticated. And I think those systems are the result of conversations between subject matter experts, risk managers, and the developers. Because anything you can articulate, I think, can be done in technology.
Absolutely. I think that's exactly true. It's actually very powerful what you're saying, Marianne, because it's actually very true. But I would like to put the caveat. That's my consulting thing. There's a small caveat to that. The systems are very powerful in themselves, right? They have amazing engines. They do have the data sometimes, but they're really very powerful, and they can give you whatever you want. But you got to define what you want. And the other thing is you got to really understand your data. In a lot of institutions, we bring all of these systems, and we're very excited to implement them, and we have fantastic state-of-the-art systems. But then when we look at the data, we either fail to understand it or fail to use it in an intelligent way that actually brings us to the result. And simple examples, right? Taxonomy misalignment. It's like a simple little thing, right? Between market risk, credit risk, operational risk. Each one has a different taxonomy. Think about it as an amplified Wells Fargo with all its institutions worldwide. I'm not saying Wells Fargo has that problem. But imagine Wells Fargo is abroad, is a big bank, global bank, or a bank having a presence everywhere in the world, Wells Fargo or others. Imagine the taxonomy misalignment. It's a simple problem. What's the name of a bond here? What's the name of a bond here? What's the name of your customer here? How do you label this customer here? And then the inability to have a unified, standardized taxonomy will not help. You can have the best system, but then you're failing on simple things. And I think what the industry is trying to do right now is to really go at all of these problems, modernize what they call their application stack and their data stack, to get to a level where there's a little bit more standardization to get us to use these powerful systems that are probably here, some of you are presenting here, to really be efficient and produce the beautiful state-of-the-art preventive risk and risk analysis that you can have.
Yeah, I also think there's, I'll give the practical side, especially the last organization I was at is, you can introduce the best tools in the world, but we may not be ready as an organization to use some of the functionality. And I always found that quite surprising is, I went and said, is this feature available, enhancement? They're like, yes, we just haven't turned it on yet. And actually, part of the reason why some organizations haven't turned on features is, how do you write the policies, the procedures, the education, especially in a large organization? The second is, especially some institutions that have come together because of mergers, acquisitions, sometimes there's already a lot of systems. In order to go to a cloud-based solution takes a lot of time. So one of the things that I'm personally curious about is, in the next 10 to 15 years, as you look at some of the large banks, especially that were created through acquisitions, can we really transform all of the systems as much as we say? Because there's great technology out there, state of the art. I don't know if some of us are ready to use it.
Knowledge is power, but a little knowledge is a dangerous thing. Okay, the UN is in session this week, so I would be remiss if I didn't bring up geopolitical risk as a category. Clement, are you dealing with that in any fashion? And if so, how?
So I'm not personally dealing with it in my role right now, but I would say what I'm aware of, and I'm sure it's many of you are, it's impacting us with inflation. So I'm not sure how many people have gone out to the grocery stores recently, but the costs have definitely increased with inflation. I think some organizations are making decisions on which clients, which countries are we comfortably dealing with, especially with the Russia sanctions and tensions recently. So, and the other aspect of geopolitical I like to weave in is ESG. So what are our environmental, social ambitions and targets that we have to make? So I'm not personally dealing with it in my role, but I think it's quite important, and it definitely weaves in many different aspects.
Yeah, I think geopolitical risk is quite important, as you guys know. So there's in capital market particularly, it's a risk that has been quote unquote under control in a way, because you can simulate it through your foreign exchange exposure, you can simulate it through your interest rate exposure, you can also simulate it through your commodity exposure, essentially basically based on your portfolio. So you can simulate all of these things. But I think what's interesting with geopolitics today is the swing and the volatility of it. And again, it goes back to this concept of institutions are no longer looking at risk once a month, or they're not longer looking at it when you're doing a potential scenario. You're getting a scenario from the regulator to simulate your potential big swings in geopolitical risk. You're actually looking at it in real time. And you're actually looking at the impact of Mr. P or Mr. whatever that person has said in real time on your portfolios and on your entities, essentially. And again, it goes back to this concept of making sure that your architecture that's supporting risk is evolving towards this endpoint of real-time risk, real-time data management, real-time risk, and real-time risk management, essentially. So you can actually really see in real time the impact of these potential volatility and these moves on your portfolios, essentially.
And the war in Ukraine has really spawned just a deluge of directives and OFAC issuances that we've had to keep up with. And personally, I've spent the better part of the year, because this started probably around February, trying to make sure we don't have sanctions risk in that arena, because sanctions liability, as some or all of you know, is strict liability. So if I process $1 of transaction with a sanctioned party, we are at risk of violating, OFAC edicts. But sanctions risk doesn't just stop at screening for the entities on the SDNs. There is sanction circumvention that you have to be on the lookout for. My own bank is Taiwanese-based, so we actually don't do a lot of business in that part of the world. However, we do a lot of business in parts of the world that are not signed on to the sanctions program, i.e. China and India. And so our relationships and the counterparties, the customers' who are in that sphere, who may or may not be aiding and abetting the Russian war effort because they are not signed on to the sanctions regime that the U.S. has, advocated. We have to watch out for that. So there's peripheral risk, not just direct risk.
No, absolutely.
Yeah.
I think AML is definitely one of these measurements, or these measurements of risk that is definitely moving pre-trade and definitely moving to the front end of the spectrum as well, to really understand the predictability aspect of certain potential risks, certain potential risk on counterparties, or risk essentially on transactions. So yeah, absolutely.
Yeah, so risk assessment for AML, since you focused on that, is probably the one that has gotten the most complicated, because now there used to be 4 pillars of a good compliance program, and in 2016 they added a fifth, which is know your customer, customer due diligence as a fifth pillar. And starting in 2018, all the banks had to collect ultimate beneficial ownership information. With the AMLA passage in January of 2021, I think, the US government has decided we are going full bore on this. All the agencies have been empowered to legislate more, to promulgate newer rules on the collection of who's behind all these shell companies and entities that are doing nefarious activities, sheltering money, and supporting terrorist financing. So for risk assessment in the AML world, it is not one-dimensional anymore. It really is multidimensional. So it's knowing your customer, knowing your customer's customer, knowing the counterparties who deal with your customer, and understanding the ownership structure. We've had to now collect ownership charts. And so all of that is a new subject of risk management that didn't exist, not in this form anyway, until just recently.
Yeah.
And then with the geopolitical changes, one day this country is on the sanctions list, next day it's now a friend, not foe, and we just have to, our systems and our people have to be attuned to that. I remember another conversation I had with a first-line checker in dispositioning sanctions at a global bank, and he said something very glib like, oh, Ireland, that is not a high-risk country. Well, Ireland may not be a high-risk country in certain respects, but Ireland has, over the last decade or so, become a place where shell companies like to register and organize for whatever reason. So there are all these hidden developments in the business world that if one is not up to date on, you're not going to realize that suddenly there's now a risk. Or Luxembourg. If you looked at the Panama Papers, how many of those shell companies were organized in Luxembourg?
Yeah. It's
and
funny
it
that
was
you
a sleepy country.
It's funny that you mentioned Ireland. You know that First Derivative is an Irish company.
I'm sure you're getting all the tax benefits that you deserve. And when the Russian laundromat operation was exposed, where were the places that were processing these? Latvia. Who would have thought Latvia would be a hotbed for processing money laundering originating from Russia? So a lot of those former satellite states, were in the forefront of a big money laundering operation. And so we really have to keep abreast of geopolitical developments in order to know what's the next place I should be looking at. Yep. One of the questions I always ask at ACAMS when they host a regulators roundtable is, what country should I be worried about? Don't give me the usual suspects. What are the neighboring countries or other ones that the State Department knows about and is interested in that banks should get ahead of? Sometimes they'll tell you, sometimes they won't. But I think that is how we can really, keep abreast and not just be surveilling for yesterday's news.
No,
everyone knows about Iran. No, everyone knows about North Korea. But what's the next place that's going to blow up and say, oh my goodness, all this, nefarious activity was happening in this sleepy little republic somewhere?
Yeah, I would challenge to say, which country shouldn't you worry about now that you have cryptocurrencies as well?
Oh, so now we haven't even talked about crypto and MSBs as a risk area. Yeah. And if you've read the 2022 National Risk Assessments, MSBs are front and center, crypto assets front and center. So
we've seen the impact of that on the shares, on the value.
So for risk managers, your portfolio is growing of what you need to be watching and building a system for.
Absolutely, and I think this is actually, jokes aside, this is probably actually the next big thing, right? So everybody knows that digital assets is the big thing right now. And, there's going to be more and more banks and institutions, financial institutions involved in digital assets, trading them, hosting them, keeping them in custody. And then how do you assess for that? How do you understand what a digital asset is exposed to? who owns it, and all of these things are going to come up as really more complex layers on top of your risk management frameworks. I think Clement talked about ESG as well. I mean, this is the big thing. This is the elephant in the room, essentially, as well, right? Understanding how to assess, these types of environmental risks. In the past, we used to only worry about carbon risk and climate risk to a certain extent, and now it takes another proportion. It's going to be integrated in your whole chain of models and valuations, and then understanding it, assessing it, understanding the data to start with, believing these companies when they're announcing these types of data, and oh, really, okay, are you really that green? Are you really that ESG friendly, whatever it is? The measurements and understanding all of that is going to be a challenge in itself.
Well, I think our time is running out, so I need to entertain questions from the audience, so I can allow anyone with a question to have the opportunity to.
I think on the left.
Yes.
How do you think the rollout of the CBDCs that are coming out, all those central bank digital coins, will reduce risk for those type of for those digital currencies, and will they be adopted by the marketplace, or do you think we're still going to see a very decentralized, multiple blockchains, multiple assets, multiple coins, et cetera?
Are either of my colleagues equipped to answer that?
I can take a stab at this, right? I'm going to respond by a question, if you don't want. I think it's interesting that this whole concept of cryptocurrencies and digital asset is, the whole principle of it is decentralization. And now suddenly you have the regulator coming in and said, oh no, we got to regulate and centralize and really understand what's happening there. The question is, it's a tough question that you have, obviously, but the essence and the idea, the philosophy behind that is questioned now, right? Why do we even need that if we're going to regulate it? So it's a challenge. I don't know if it's going to be able to really have an impact, but I think banks will have to adapt because the regulations are going to be imposed on all of these financial institutions. So it's going to be interesting to see the reaction of the market and the investors as well.
I think you should attend a crypto seminar, because that's a perfect question for specialists in that.
Yeah. And they would probably disagree with what I said.
Also, you're right. It's totally anathema to the idea of crypto to have a central bank. The anarchists love crypto. And I've watched an HBO documentary on anarchists, and they used to hold annual meetings in Acapulco to celebrate anarchy. And cryptocurrency was the main event, because that was their way to fight the man, fight the banks. So your question really is a big contradiction in terms, but it is happening. So I think you need to consult with more crypto-centric experts. We're just risk management people. Any others? Oh, I see one in the back.
You mentioned OFAC circumvention, so I was just curious if you have any sort of ideas about what sort of controls are best put in place to kind of address that.
There's a limit to what you can do. We are not the world's policemen. We're not the FBI. We're not Interpol. So there is a limit to what banks can do to find circumvention attempts. If people really wanted to circumvent OFAC sanctions, we're not in the best position to smoke that out. However, we can keep our eyes on the higher risk activity, higher risk entities. So know your customer is my mantra. If you know your customer, you're halfway home, because anything that's anomalous in their typical business activities, you will be able to see that. And if you run a clean business and your KYC does a good job of vetting your customers, then their customers are likely not to be dubious organizations and criminal organizations. Sanctions, circumvention traditionally has been done when if a transaction is blocked and rejected by a US bank, foreign correspondent banks have resubmitted it with taking out the offending language. For instance, for further credit to the Iranian Red Cross, they'll take out the offending word Iranian because that's what's tripping the sanctions filter. And so there's been resubmission. So that's one way you can check for sanction circumvention is blocked and rejected transactions when they're coming back again, because they probably have stripped the wire message of anything that trips up your sanctions filter. This year we had a project to look at our customers' counterparties and do additional due diligence on them. And we used a risk-based approach. Who are our customers who do the most business in those jurisdictions that are friendly to Russia, that might be enabling Russia? And then based on certain risk criteria, what's their line of business? If they're selling electronic components or even, or armaments or chemical ingredients, those would be higher risk. If they're just selling shoes, we would not bother to look at them. With the risk-based approach, we selected certain customers and looked at their counterparties to see if there's any connections we can find in the public source. We use WorldCheck, LexisNexis, Dow Jones, any number of open source research just to see what we can find. But that's pretty much what the limit of what you can do if you're, a small branch like us, and it's not high risk in our book because we don't play in that part of the world. I'm sure there are much more sophisticated techniques at the bigger banks who do have exposure because they do transact a lot with the pipelines and and all that coming out of Russia. So those entities will have to have better tools and more in-depth studies of what exactly is transacting through their systems to catch sanctions intervention. But in the end, if you've missed it, sanctions intervention attempts are not strict liability because we're going above and beyond just screening for the people who the government says you can't do business with them. If we help the government find that, we get brownie points for that. And we also assure ourselves that we want to offboard these people who are doing this type of business because one day it's going to morph from marginally dangerous to dangerous for our reputation and our licenses. So it's just a few tips that I mentioned, but I'm sure there's more. But thank you for the question. I think we're out of time, Richard.
Yeah, we are. Thank you.